While our Q1 GDP was down by 5%, the real story on the U.S. economy is going to be told with the Q2 reading. Our chief equity strategist and economist, John Blank, joins me now to explain. John, why is Q2 more important?
Well, first of all, Terry, in any number like this, we want to watch the internals of consumption growth or the lack thereof. And we also want to look to see if government stimulus is showing up in meaningful ways. So in an economy with so much government stimulus being provided, which starts basically in March, we want to see how that flowed through into the Q2 GDP accounts. And that's really a novel exercise. So the point here is it's going to be a weak reading. That's not the point here. The market won't trade on that. The market will trade on seeing the flow through from incomes to consumption through the stimulus channels. So really, it's a Keynesian exercise, and that's what the GDP accounts are for.
So then are we in an economic malaise or a full recession?
We're certainly in a full recession. I mean, you're looking at 90% declines in air transportation, the shuttering of most of the retail stores that are small mom and pop groups. Very unlikely to see those come back. More than maybe 60% of them, 40% will never come back. So very hard to say this isn't a recession, and it's certainly going to be a longer one than people think.
And now the recovery is projected to be more gradual than previously forecast. I like that word, gradual. So with that in mind, would you term our economic recovery fragile? And if so, just how fragile?
Fragile is not a word I'd actually use, because you have two government efforts that are not only U.S. specific, but around the world specific. And that is the vaccines. We had 160 of these things, and at least a handful are in very solid state of affairs. That's government-funded, distributed recovery. And the other is the support packages that all the governments of the world are making available. We know the Fed is printing money and supporting the stock market, but it's for the economy. It's the fiscal stimulus packages that matter, and that's what's making things unfragile. So the way that we get to fragile is discord in our politics that really does lead to a lack of government stimulus for people who are unemployed.
And now we're looking at another bad reading for corporate profits for the second quarter, Q2 earnings season currently being underway. Is our economy going to recover only after corporate profits recover?
That's a question for the accounts to answer. I don't think the markets are being that attentive to that issue, but certainly corporate profit recovery will be a leading indicator of the economy's recovery if I were to bet on that. And in that sense, it will be helpful to get this thing moving forward.
Is there a key you're looking for as to when there be a recovery in these corporate profits going forward?
Yeah, I'm looking for the travel businesses to work themselves out. I think, anything that works in travel will work in restaurants and outside of all of that. And so leasing of planes, everything to do with the transportation sector, plus opening the United States to business and tourist travel to the rest of the world. So you got to believe that until the travel businesses turn around, the rest of the market's not going to get turned around.
How can we tell if our stock rally still has legs to go further?
Well, that really is about the Fed, and the Fed is, putting together 11 new credit facilities in this 13.3 section of emergency things in March, and we'll continue this till the end of 2021. So without the Fed stopping this rally, and they're not going to do anything for another year and a half, you might as well just play the momentum. And that doesn't mean there won't be corrections, Terry. And I think that's what people have to get in mind, that there really can be corrections in this whole thing.
And this being an election year, do you see COVID-19 being more critical for the markets and earnings this year over the November election?
Well, the November election is being decided on the management of the COVID-19 situation in the United States. So insofar as the COVID-19 situation has been mismanaged, which I believe it has, it is affecting the election, and that is determining, the path taxes and spending programs for 4 or 5 years to come. So that's the relationship right now, is the mismanagement of the COVID situation is setting very different terms to the November election.
The tech-heavy NASDAQ has been flirting with history lately, John. You wrote in a commentary, tech is the leading sector in this rally. And on Monday of this week, in your commentary, you posed this question. The major S&P 500 tech stocks move higher with strong earnings reports. Tech companies reported Q2 earnings this week. Has your question been answered?
Well, let's take up two of them, Snap and Tesla. Both of these names, are growing their businesses unprofitably. And Tesla obviously reported a profit, but that's only with the regulatory credits being baked in. The basic truth with Tesla is they have learned what every other car maker has learned in the last 100 years is it's impossible to make a profitable vehicle that's electric yet. And they're still not doing it. So, and then you got Snap, which, had 250 million subscribers, a lot of strong subscriber group. That company's never made money. So people buy the story of the underlying business growth, and that keeps the momentum traders happy. So I'm not going to be the guy to tell when these momentum traders are going to be unhappy. But if anybody's playing games with these stocks for anything over a week or a month, I would think you're crazy, because Tesla at $1,600 can easily go back to $200 or $300.
So as far as tech in general, are we looking at a rotation into tech and away from the larger cap stocks?
We're looking at nothing but momentum trading on existing trends. And until those break, there's no rotation. So impossible to know when that rotation is coming. But I wouldn't bet on it. I think people are just going to stay happy with the Fed for at least a while.
Let's take a look at some of those tech names that's on your radar right now. Advanced Micro Devices, Micron, and Microchip Technology.
Yeah, these are three very different plays right now. Microchip Technology, ticker MCHP, you may not have heard of. They're actually the most profitable and the highest priced stock of the bunch. It's $105 a share. MCHP is based in Arizona, and what it is a Sequoia Capital acquisition roll-up. What that means is Sequoia was a big venture capital firm in San Francisco, bought an existing chip company many decades ago, and then been throwing smaller companies into this mix over time. So this is your classic way the VCs work. They find some, big tree and they graft in all these branches from various parts of the chip business. So this has been a phenomenal stock up until about 2018, and now it's just been range trading because of the disconnect in the international economy. So Microchip Technology 110, kind of at its highs, probably from a stock market perspective, probably at the top of the range and not a good time to buy. Advanced Micro Devices, ticker AMD, has gotten itself on a very major role, and the momentum is fully in play with this stock. This is a true momentum stock. What happened here is they bought a graphics processing company in Canada years ago, ATI, and then they sold off their fab company, was called Global Foundries, and now starting to work with Taiwan Semi in Taiwan, which is the largest Taiwanese semiconductor company and probably the largest one in the world. So science-driven Taiwanese know-how is flowing through AMD, and it's flowing into this graphics processing group they have, which then ends up being this competitor to NVIDIA. So anytime you do graphics, you're doing gaming's 3D, and people get this artificial intelligence lift out of the chips that supply it. So AMD's been this type of chip. Problem there is the momentum is fully on, and you're counting on huge growth out of this company. And if it doesn't hammer out that way, you're going to be in trouble. So again, AMD, great trading stock, not one I would be comfortable owning in a pullback because this thing can go down very hard. Micron's a third of the ones. Micron made $11-12 a share a year or two ago. Now they're down to $5 or $6, even $3. But the stocks hold up pretty well. It's about $50 a share. If you get a recovery in the virus counts and you get some opening of these three names, the opening trade is probably Micron. So again, from the story of the economy, all these are very highly ranked Zacks industries. Some of them are 1, some of them are top 10%. All of them are strong. But from a stock market perspective, you really got to pick your way through this stuff and be very careful. And that would be my message for everybody.
All right, that's the latest on the economy and stocks from our chief equity strategist and economist, John Blank. And with John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.